fundamental
risk.
understanding by management of risk.
Yeah.
When you got to Bank One, I think this is where you first started putting into practice the culture around risk. What was the risk culture at Bank One, and how did you change it?
Yeah, I've always been very risk conscious. And risk conscious does not mean getting rid of risk. It means properly pricing it and understanding the potential outcomes. And so when I got there, I just started meeting people and going through. I quickly realized that Bank One had more U.S. corporate credit risk than Citibank did. And the way they accounted for it was unbelievably aggressive. And so they had less capital, less reserves, less this. They were calling these things profitable. They were basically losing money. And loans in a lot of business, you got to be very careful about the credit business. And once I found out that, I kind of panicked a little bit. And I went through every single loan in the books. I marked them all down, put up more reserves, told the board about it, and then wanted to earn more revenues per dollar of risk. So for example, in the middle market business, we had, for every loan NII, we had like 80 cents and 20 cents.
Net interest income for the
net
non-banking.
interest income from the loan, and 20 cents of other revenue like payments. By the time we merged with JP Morgan, we had 40 NII from the loan and 60% NIR from other type of things like payments. And one, you're being paid for the risk, and one, you're being paid little for the risk. And I always stress tested, and I showed the board that if we have a recession, and we're about to have one, how much money we'd lose in credit. So I hired a woman called Linda Bamman who said, okay, if you're gonna let me do credit, you're gonna let me sell loans? I said, yes. Are you gonna let me hedge loans? Yes. Can I do 10 billion? I said, yes. She said, okay, I'll join. And we probably reduced the balance sheet by 50 billion and then we did have a recession, but we were kind of okay by then. With one big bad one, which is United, which went bankrupt. And we basically owned it for a small period of time.
There seems to be kind of a fundamental Jamie Dimonism, which is don't blow up. I mean, a lot of other people have gotten decent at pricing risk, but everyone else seems to be willing to get closer to the line than you. Where did you sort of develop this don't blow up at all costs
idea? So
idea?
There's, around risk, there's always this ecosystem. You've always heard it. Everyone's doing it. Everyone's okay. This is going to work. This time is different. And, the history teaches you a lot. And I always say, if you didn't, my dad was a stockbroker. And so I bought my first stock when I was 14. In 1972, the stock market hit 1,000. It hit 1,000 in 1968. I was already helping a little bit with stuff. By 1974, it was down 45%. All the limousines in Wall Street were gone. Restaurants were being closed. Markets move violently. And then, we had kind of a recovery. In 1980, you had a recession. 82, you had a recession. In 82, it was lower than it had been in 1968. And it hit 800. And then in 87, the market was down 25% in one day. In 1990, all these banks, JP Morgan, Citi, Chase, Chemical, were all taken to their knees by real estate losses, and they were all worth about $1 billion. I think Citi was $3 billion at the time, and the other ones were about $1 billion. And then you had the 97, also real estate related thing. You had the 2000 internet bubble, and then you had the great financial crisis. And if you go through history, there's tons of these things. Andrew Ross Sorkin is in here, and I just read his book. He's nice enough to send it to me in 1929. And man, history does rhyme. Too much leverage, too much risk. Everyone thinks it's going to be great. No one thinks it can go down a lot. And that stock market went down 20% one year, 30% next year, 20% next year. At one point, it was down 90%. Shit happens.
It seems like your philosophy is that the worst thing will happen. So just plan for it. Don't say, oh, we're good as long as this crazy, insane, Four Sigma event doesn't happen. You're like, no, that will happen and happens often.
Yeah, so when I look at it, I always ask, like when I do stress testing of risk for high yield, I remember getting to JP Morgan and going through the risk books, and their stress test was that high yield would move 40%, the credit spread. That's good. And at the time it was at 400 or whatever it was. That means 560. Okay, and I said, no, our stress test is going to be worst ever. Worst ever was 17%. And they said, that'll never happen again. The market's more sophisticated. Well, in 2008, it hit 20%, and you couldn't have sold a bond. There was no market. So, those things do happen. And the point isn't that you're trying to guess them. The point is you can handle them so you can continue to build your business. And so I always look at what I call the fat tails and manage that we can handle all the fat tails. and not the stress test the Fed gives us, but all the fat tails. Markets down 50%, interest rates up to 8%, credit spreads back to worst ever. And of course, your results will be worse, but you're there. And the thing about financial services, leverage kills you, aggressive accounting can kill you, which a lot of companies do. And the goal should be, and also confidence. If you lose money as a financial company, I always knew this too. The headlines are, people read that, and if they're relying on putting their money with you, they look at that different. So
they lose trust.
They lose trust, and that's what's caused. You've seen runs on banks, and you saw some recently, because people take the money out.
So there's a thing that you just said, which is that you might do worse, but you're there. There's sort of this trade-off that you make where you're less profitable in the short term, but at least you stick around. If you look back at the companies that you've run, Bank One, JP Morgan Chase, is that true in the good years that you've actually been less profitable than those who are kind of risk on?
Yeah, a little bit. He's saying that, if you look at the history of banks, from up until 2007, a lot of banks were earning 30% equity. Most of them went bankrupt. We never did that much. Okay, but in 08 and 09, we were fine, and they weren't. And so, but you want to build a real strong company with real margins, real clients, conservative accounting, where you're not relying on leverage. And it's very easy to use leverage to jack up returns in any business, but in banking, it could be particularly dangerous.
So it seems like a core part, if not the entirety of this distilled into your operating strategy, is the fortress balance sheet.
Yeah.
When did you first hear about the fortress balance sheet?
I've been I go way back to Primerica. I used to talk about that. You're going to be able to survive the tough times.
Early 90s?
Probably the 1990s. And like I said, I grew up with my father, and I went through those market things. I remember how hard it was on people on Wall Street. But the fortress balance sheet is that you run a company serving clients well, you have good margins, good liquidity, good capital. I'm as conservative an accountant as you can find. I don't upfront profits when I can spread them over time. And accounting, of course, accountants hate it when I say this, you can drive a truck through accounting rules. And accounting itself, that certain things are considered expenses, but they're good. They're an investment for the future, but they're called an expense. And then revenues, if I make bad loans, they are bad revenues. They will kill you, but for a while they look pretty good. So it's all those things, margins, clients. In the banking business, the character of the clients you have will reflect on your bank. So the first thing is, who are you doing business with? How are you doing business? And and also making sure your compensation plans aren't paying people for stuff which is stupid or unethical. And and you always have to review these things to make sure you have them right, because they change all the time.
All right, David, catch us up to the merger.
So you run Bank One for 4 years from Chicago, and then in 2004, you merge with JP Morgan Chase in what is termed at the time a merger of equals. I think JP Morgan Chase referred to it as that. Bank One shareholders get 42% of the combined company. I mean, I think people don't realize how much of JP Morgan Chase is Bank One today.
That's why it's a little irritating to me when they say you've been running it since I was running JP Morgan. I was running 40% of the company for the whole time. And when I got to Bank One, and I'm not working around the clock, I already knew that a logical strategic merger might be JP Morgan. Okay, I know all these companies, and that's the other thing about Fortress balance sheet, is you also have real strategies that survive the test of time, and you're not flipping and flopping. And then I'm sitting there, and across the tape comes JP Morgan Chase to merge. So we're worth like $25 billion. They're now worth like $80 billion or 90 or whatever the number was. I'm like, well, there goes that dream. But 4 years later, our stock was up to, doubled or something like that. Theirs actually come in, and it was in the target range. And I had been meeting with Bill Harrison, the current chairman of JP Morgan at the time. We were talking about it. We both knew it made business sense. They were kind of looking for a CEO. So we had been talking probably for a year and a half before that.
They're looking for a CEO. Did they give Bank One shareholders 42% because they were looking for a CEO?
There were 2 lawsuits. Okay, so we got the premium. They got the name and the location, and I effectively had kind of control from day one, because inside the merger agreement, and this is almost unheard of when we get the premium, is that to not have me become CEO 18 months later, 75% of the board would have to vote me out. And the board
default was you were going to become CEO.
And the board was 8 Bank One people and 8 JP Morgan people. And I knew a lot of the JP Morgan board members too who respected me. And Bill Harris and I were very close, but that was the agreement. They got sued for paying too much to buy me. I got sued for not taking enough. I mean, you get sued, you can't win in these things.
I think every shareholder is probably
But it
happy
worked.
today.
It worked out.
Yeah.
All right,
how much-
2006.
Before we get to 2006, when you were going through that process, and even maybe the couple years before you and Bill were talking, you're starting to think about JP Morgan as a partner. I'm curious, did the name JP Morgan factor into your thinking at all? Did you view that as an asset?
I mean, JP Morgan brand is a Tiffany name. I didn't value it in the deal. And what I looked at, I had given my board, I think the first thing is run your company well. And people thought I was going to start doing deals immediately. I was like, no, we suck. We haven't earned the right to run someone else's company yet. When we're running a good company, we can merge with somebody. But the first thing I looked at was business logic. And that every business, we had a consumer business, they had a consumer business, we had a credit card business, they were both terrible. They had a credit card business, they had a big investment bank, we had a big US corporate bank that needed some of those investment banking services. We both had a wealth management business. I knew we could save a lot of cost saves, so the business logic was pretty impeccable. Then there's the ability to execute. Like, can you actually get it done? Because you've all seen a lot of deals where they fall apart. They don't have management, they don't consolidate the systems, they have infighting, it kind of happened at Citi, and so you don't effectuate, and then there's the price. So I knew we had a Tiffany brand, but it didn't value, because if everything else didn't work out, I don't think it would have mattered that much.
Interesting.
All right, so I'm going to fast forward us a couple of years. It's 2006. You're officially chairman and CEO of the combined JP Morgan Chase.
And
entity now.
2006 on Wall Street is like
go,
baby. It's like 1980s all over again.
It was.
I think you had the same incentives as everyone else, but you behaved very differently. Am I missing something? Did you have the same incentives, or
you
did
pulled JP Morgan back hard on the
did.
risk side in 2006.
I did. So there were cracks out there in 2006. You may remember the quants. There started to be a quant problem, and in 2006, we definitely saw subprime getting bad. And I pulled back on subprime. I wish I had done more, because if you look what I did, you say, okay, well, you saved half the money, but you would have saved more.
Yeah, you still had some losses.
Yeah,
$5 billion?
but we also had, I'm going to say, maybe a third of the leverage of the big investment banks, and a lot more liquidity.